What's going on, guys? Today we're going to be looking at continuation patterns and how we can implement them into our trading strategy to better understand when an existing trend is going to continue or if it's going to reverse its existing trend. So before we jump right into this, I want you guys to understand with reversal patterns and continuation patterns, it's never guaranteed to have the same outcome every single time, right? So just because, let's say, a bull flag worked for you one time and its outcome worked phenomenal, does not mean it's going to break out to the upside every single time, right? Because the belief of one trader or a few traders, if they have a different belief in the future direction of the market, and let's say they sell a heavy position and price breaks out to the downside, that doesn't mean that the bullish flag is never going to mean that it's going to break out to the upside again, right? It just means that this time it didn't work. It had a lower probability of working. So just always keep in the back of your mind, every pattern is unique in its own way, and do not have very high expectations for it to to perform the same exact way that it performs every single time, right? So let's jump right into it. The bullish flag pattern. This is also known as a rectangle, right? A bullish rectangle. Bullish flags are found within strong uptrends. They are called bull flags because the pattern resembles a flag on a pole. The pole is the rally up, and the flag shows a period of consolidation. The flag can be a horizontal rectangle as well, but it is often angled down away from the current trend. This is very similar to a bullish pennant, except the consolidation forms a symmetrical triangle. We're going to be getting into the pennants in the next couple slides, but for now, let's focus on the bullish flags, right? So as we can see, we have our flagpole, right, that run up rally, and then price starts to consolidate between these two channel lines, right? We have our sloping down trend line, which is support. We have our sloping down resistance line, which is resistance, right? So now, if we look, what happens? Price is angling down, right? The channel is angling down against the previous trend. So now, as price starts to bounce off of support, we can see that we start to have an upside breakout, boom. And now once we have that upside breakout, price continues the previous trend. But now, how do we know how far price is going to break out, right? The way we measure the breakout length is we take the flagpole and project it upwards from the breakout, as we can see here. We take this flagpole, right, and we project it upwards from the breakout point. And that's how you would get your target profit area of where you would most likely want to take your profit. So these are very, very commonly seen, actually, and I actually trade these a lot. These hold a lot of significance, especially on higher time frames. So now the bearish flag, also known as the bearish rectangle. Bearish flags are found within strong downtrends. They are called bear flags because the pattern resembles a flag on a pole. The pole is the pullback, and the flag shows a period of consolidation. The flag can be a horizontal rectangle as well, but it is often angled up away from the current trend. This is very similar to a bearish pennant, except the consolidation forms a symmetrical triangle. Again, we're going to get to the pennants in a couple slides. So let's look. This is basically the inverse of the bull flag, right? We have the flagpole coming down in a strong downtrend, consolidation sideways, right? And then we can see we have a breakout to the downside, right? But now where do we get this price target down here, which is based on the flagpole? We measure the flagpole and project it downward from the downside breakout. Then, as we could see, price tried to pull back up, but we couldn't retest this high. And guess what? We continued the downtrend until finally we ended up pulling back up a little bit. But this is basically how the flagpole operates, right? So after a downtrend, price consolidates, sloping upward. And then as we hit that resistance, boom, we shoot back down and we break that support line. This is also very, very common. So now the bullish pennants that I keep talking about, right? Bullish pennant pattern. The bullish pennants are continuation patterns that occur in strong uptrends. The pennant is formed from an upward flagpole, a consolidation period, and then the continuation of the uptrend after a breakout. Us traders look for a break above the pennant to take advantage of the bullish momentum, right? So, as we can see, similar to the flagpole, we have our pole that shoots up. But then instead of having a channel, right? Let's go back. Having this channel line, right? See these sloping up channels? Instead, we have a symmetrical triangle that it forms between, right? Price consolidates between this symmetrical triangle until finally, boom, we have that upside breakout and it continues the existing trend. And because nothing goes up forever. Nothing goes up forever without coming down and pulling back a little bit, right? So you could think of this consolidation as a pause in the existing trend, right? We're on a major uptrend. We pause, and then we continue to push upward, right? So now next, we have our bearish pennant pattern similar to the bullish pennant pattern. So bearish pennants are continuation patterns that occur in strong downtrends. The pennant is formed from a downward flagpole, a consolidation period, and then the continuation of the downtrend after a breakdown. Us traders look for a break below the pennant to take advantage of the bearish momentum. So we look to profit from a short in this situation, right? Because as you can see, we ran up, hit our peak, boom, had a major downtrend. Once we created this flagpole, look at what happened. We start forming in a symmetrical triangle again, bouncing, till finally we had that breakdown. Now, how would we want to play this breakdown, right? I have an example right here for you. So once we have that strong downtrend, the flagpole, as we can see here, we start consolidating, right? Consolidate. So once we see price breaking down below this symmetrical triangle, as we're doing here, we should enter for a short position right about here. Put our stop loss right above here, right? Because we could retest back up, but if we hit our stop, we want to get immediately out of that trade, right? And then our profit target is going to be projected the same way. We take the flagpole length and project it downwards, right? Now, this could exceed the flagpole. This could not really fully reach the flagpole length, or it could exactly hit the flagpole length, right? Nothing is certain, but it's a good estimate about where the breakout is going to reach, right? So now let's look at the bearish rising wedge. I'm not going to say it gets complicated here, but you need to know the inverse of the bearish rising wedge and the falling rising wedge, right? So the rising wedge pattern is a continuation or reversal pattern formed when price bounces between two upward sloping converging trend lines. It is considered a bearish pattern, but can indicate both reversal and continuation patterns depending on where it appears in the trend. So let's look here. A rising wedge is a reversal pattern in an uptrend, right? So it's a reversal pattern in an uptrend and a continuation pattern in a downtrend. For the falling wedge, the exact opposite is true. It is a reversal pattern in a downtrend and a continuation move in an uptrend, right? So I'm going to break this down and explain to you exactly what this means. So as you can see here, we have our rising wedge, such as what we're talking about now. You can see this is a continuation of the previous trend. So we had our downtrend, right? Our downtrend, and then we have our rising wedge, which means that it's a continuation of the previous trend simply because it was a downtrend. But if we had a rising wedge in an uptrend, that indicates a reversal pattern to the downside, right? Reversing the previous uptrend that we had. So this pattern is not necessarily either or. It's a continuation pattern or a reversal pattern depending on where it is in the market that you're looking at it and depending on the trend, right? So the circumstances really take a major part in this pattern. So as we can see here, the rising wedge, right? In a downtrend, it's not a reversal, right? We have the rising wedge. This is a continuation. The downtrend, rising wedge, boom, breakout to the downside. In a falling wedge, which is what we're going to talk about next, we have our uptrend, falling wedge, breakout to the upside, right? So this is what we're talking about now, the rising wedge. After we have that downtrend, we consolidate the rising wedge, and we break out to the downside. Again, we measure the breakout with the pole projected downward from the breakdown zone. So if we look, I just want to reiterate it one more time. The reversal of the previous trend, right? So if we have an uptrend and we see a rising wedge in an uptrend, that signals a reversal. If we have a downtrend and we see a rising wedge, that's a continuation of the previous trend, which is the downtrend, right? So these are patterns that you're going to want to look at over and over and study, because these are going to come up while you're trading and you don't want to get confused and be like, you know what? This actually means it's going to break out to the upside because it's a rising wedge, but you don't know if it's going to be a reversal pattern or a continuation pattern, right? So this is something you want to look at very, very, very closely. So now the bullish falling wedge, right? This is the cousin of the other one, the rising wedge. So the falling wedge pattern is a continuation pattern formed when price bounces between two downward sloping converging trend lines. It is considered a bullish pattern, but can indicate both reversal and continuation patterns depending on where it appears in the trend. So the falling wedge is a reversal pattern in a downtrend and a continuation move in an uptrend. So as you can see, we have our uptrend, falling wedge, then we have, boom, our breakout to the upside, which should happen, right? We have our uptrend that happened, our falling wedge, breakout to the upside. See that? But if this was the inverse case, let's say we had a downtrend, right? We had a downtrend and a falling wedge. Let's go back. We have our downtrend. If we had a downtrend, oh, right here. Our downtrend and a rising wedge, it's going to be breakout to the downside. So you really, really want to look very, very closely at what direction the wedge is facing in. If the wedge is facing down in an uptrend, it's more likely going to break out to the upside. If it's an uptrend and it's a rising wedge, right? If it's an uptrend and it's a rising wedge, price is more likely to break out to the downside. If it's a downtrend and it's a rising wedge, price is going to break out to the downside, right? Because that's a continuation. So these are two major patterns that I would study over and over and over on, right? We never understand stuff from just looking at it once, right? You have to identify it. You have to go through experience, trial and error, right? So this was a basic understanding of continuation patterns. I'm going to be doing another video on how we can actually trade these patterns and incorporate them into our trading setups, right? To profit from these, whether we're going long or going short. So I really hope you guys like this video, and I hope you could hit thumbs up, like, subscribe. Take care. Everybody have a blessed trading week. Let's make this money.